Good afternoon, folks. Welcome to the Liberty Call. It is Thursday, July 14th, 2022. Hope everybody's having a great day out there. And let me make sure my mic is working. All right. It's unmuted. All right. Hopefully you can hear me. Anyways, it looks like the markets reacted very well to the bad news that we got yesterday about the inflation. Granted, it is a month-old news, so don't get your panties in a wad about everything that's going on. But again, until we get inflation under control, it's probably going to be a rough ride. And energy has definitely been one of the bigger issues we're dealing with right now. So, all right, well, let's go ahead and jump into today's markets and see how they performed. The Dow Jones was down 0.46, closed at 3630. S&P 500 was down 0.3, closed at 3790. NASDAQ actually, well, it was in the green in the late afternoon, and finished flat at up 0.03%. Small caps were down more than 1%. The VIX pulled back again today, down another 1.57%. It's currently sitting at 2640. Moving over to the other exchanges here in the Americas, Canada was down 1.54, Brazil down 1.8, Mexico down 1.55. Headed over to Western Europe, Germany down 1.86, the UK down 1.63, France down 1.41, the Euro stocks down 1.66, Netherlands down 0.93, Spain down 1.77, Italy down 3.44%, Switzerland down 0.97, Portugal down 1.9. Check out the Russian exchanges. The MOEX was down 0.5, the RTSI down 0.57. Head on over to the Asian markets. Japan was up 0.62, Australia up 0.44, New Zealand up 1.01. Let's move down to the Chinese markets. The Shanghai finished flat at down 0.08, the SESE component up 0.75%. China A50 down 0.36, the DJ Shanghai down, or basically flat at down 0.05, and the Hang Seng down 0.22, and the Taiwan weighted came in up 0.79%. So it looks like the Asian markets weren't too bad today. It was the European and our domestic markets here in the Americas that really took a beating the last couple of days. So again, not surprising. If you've been paying attention to what's going on, this is not really a shock. But hey, I'm sure there's people out there who are paying attention to the dumbasses in Washington, and this might catch you off guard. All right, well, let's go ahead and read through today's market recap. S&P 500 off lows as bets on mega rate hike ease. Banks glum on earnings miss. The S&P 500 cut losses Thursday as the Federal Reserve officials downplayed the prospect of a 1% rate hike. Yeah, of course they're going to do that. Though disappointing quarterly results from major Wall Street banks fueled recession fears and soured investor sentiment. JP Morgan said it would temporarily pause share buybacks after reporting second quarter earnings that fell short of estimates, sending its shares more than 3% lower. The Wall Street Bank also set aside more money than expected for potential loan losses, raising concerns about the strength of the U.S. consumer. Morgan Stanley also reported a miss on second quarter earnings driven by weaker performance in its investment banking business. Its shares recovered to trade flat after falling more than 2%. Wells Fargo and Citigroup, which both report on Friday, were down 1% and 3% respectively. Technology stocks turned positive as Treasury yields retreated after Federal Reserve Governor Christopher Waller played down the prospect of the Fed rolling out an unprecedented 1% rate hike later this month. Quote, "You don't want to overdo rate hikes," end quote, Waller said Thursday, adding that the market had got ahead of themselves on pricing a 100 basis point rate hike, though he didn't rule out the prospect of a larger hike. Quote, if the data come in materially stronger than expected, it would make me lean towards a larger hike at the July meeting, he added. St. Louis Federal Reserve President James Bullard reportedly also said he would favor a 75 basis point rate hike at the July meeting. The odds of a 1% rate hike fell to about 44% from 80% a day earlier, according to investing.com's Fed Rate Monitor tool. Taiwan semiconductor manufacturing gained 2% to help chip stocks erase losses after the chip bellwether reported quarterly results that beat on both the top and bottom lines. Let's see here. The chip maker also raised full-year revenue forecasts, helping to cool concerns somewhat about the chip demand outlook following Micron's gloomy outlook a few weeks ago. Energy was also one of the major decliners as oil prices added to recent losses on concerns that a global recession will dent demand for energy. APA, EOG Resources, and Coterra Energy, each down more than 3%, led the move lower in energy. In other news, Cisco fell nearly 1% as JP Morgan downgraded the stock to neutral from outperform on worries that, quote, supply and spending hesitations, end quote, will weigh on demand. So it looks like a lot of the bank earnings are not real good right now. So again, this could be a precursor for how bad things can get, in the future. But again, time will tell. All right. Next article has to do with oil. Oil settles lower ahead of potential large U.S. rate hike. Oil prices settled lower on Thursday, but pared nearly all losses after falling more than $4 earlier in the session as investors focused on the prospect of a large U.S. rate hike later this month that could stem inflation, but at the same time hit oil demand. Brent crude futures for September settled down 47 cents or 0.5% to $99.10 a barrel and finished a third session in a row below $100. U.S. WTI crude for August delivery settled down at 95.78 a barrel or 0.5%, down 52 cents. Both contracts hit lows on Thursday, which were below the February 23rd close, the day before Russia invaded Ukraine, with Brent reaching its lowest level since February 23rd. The U.S. Federal Reserve is seen ramping up its battle with 40-year high inflation with a supersized 100 basis point rate hike later this month after a grim inflation report showed price pressures accelerating. The Fed policy meeting is scheduled for July 26th and 27th. The Fed rate hike is expected to follow a similar move by the Bank of Canada, which surprised the market on Wednesday. Quote, moves by the Fed will have an outsized impact on the market as we watch them try to digest new economic data about inflation, end quote, said John Kilduff, partner at Again Capital LLC in New York. Oil prices have tumbled in the past 2 weeks on recession concerns, despite a drop in crude and refined products exports from Russia amid Western sanctions and supply disruption in Libya. Investors also flocked to the dollar, often seen as a safe haven asset. The dollar index hit a 20-year high on Wednesday, which makes oil purchases more expensive for non-U.S. buyers, but retreated somewhat on Thursday. Quote, technical indicators are suggesting another round of fresh lows as the U.S. dollar continues to rule in driving oil price direction, end quote, said Jim Ritterbusch, president of Ritterbusch & Associates in Illinois. In Europe, signals were also bearish for demand, with the European Commission cutting its economic growth forecast and raising the expected inflation rate to 7.6%. Worries about COVID-19 curbs in multiple Chinese cities to rein in new cases of a highly infectious subvariant have also kept a lid on oil prices. China's daily crude oil imports in June sank to their lowest levels since July of 2018, as refiners anticipated lockdown measures to curb demand, customs data showed on Wednesday. Data from the U.S. Energy Information Agency also point to slackening demand, with product supplied slumping to 18.7 million barrels per day, the lowest since June of 2021. Crude inventories rose, bolstered by another big release from the strategic reserves. U.S. President Joe Biden will fly Friday to Saudi Arabia, where he will attend a summit with Gulf allies and call for them to pump more oil. However, spare capacity at the Organization of the Petroleum Exporting Countries, or OPEC, is running low, with most of the producers pumping at maximum capacity, and it is unclear how much extra Saudi Arabia can bring into the market quickly. If there was only any oil in America, I know. I mean, it's totally crazy that if we could pump some oil here, it may help with some of that demand. But hey, what do I know? Let's take a look at an oil chart here. Let me expand that so you can see a little bit better. This is IEO. It's an ETF I use in some portfolios. Basically helps or shows oil demand and gives you an idea of, you can see here, this trend line starts back in November. We had this nice uptrend, or November of 20 through 2021 to now. And you can see here this resistance line that we bounced off of a few different occasions, September of 2021, and again at the beginning of the year. So right now we're kind of bouncing off of this right now. So if oil prices continue to fall, we'll see this bust through this line, which will give us an indication that maybe oil prices have capitulated, and maybe it's time to move away or reduce our oil exposure moving forward. If it bounces off and heads back up, then we may be due for a few more months of higher oil prices. So again, time will tell. All right, let's see here. Next article, June shipments decline. Latest CAS data shows volume weakened, costs hit new high. So another article talking about slowing in the economy. Freight shipments fell 4.1% sequentially in June, reversing all of May's gains, according to data provided by CAS Information Systems on Wednesday. On a year-over-year comparison, the monthly volumes data set was shown down for the fourth time in the first half of 2022. The CAS Freight Index continued to moderate during June alongside macroeconomic data points, with a cooling in consumer spending and new highs in inflation, 9.1% annualized, according to the June data release. The freight industry appears to be on the downside of the freight cycle as the back half of 2022 begins. Many retailers were chasing inventory throughout the pandemic, often pulling forward merchandise spend well ahead of normal buying patterns to avoid supply chain bottlenecks and ultimately stockouts. However, the trend has reversed course recently, with a couple of retail heavyweights signaling margin pressure as they now carry too much stock or inventory that is out of season. Quote, inventory has shifted from a major tailwind for freight demand to more of a neutral factor currently, with potential to become a considerable headwind if goods demands continues to decline, end quote. ACT Research's Tim Denoyer stated in a June CAS report. CAS reported that the shipments index dipped 2.3% year over year in the month, following a 2.7% decline in May. While the index continues to moderate from 2021 levels, it was still 23.9% higher than the level recorded 2 years ago and 1.9% higher than June of 2019. Assuming normal seasonality holds in the back half of the year, the shipments index is forecast to see year-over-year declines of 1% in the third quarter and 5% in the fourth quarter. Freight costs hit an all-time high. The expenditures index reached an all-time high in June, jumping 8.3% from May on seasonally adjusted comparison. The index measures the total amount of spent on freight. Inferred rates, or expenditures divided by shipments, were up 11.7% in June, wiping out the 9.8% sequential decline seen in May. Mix had a big influence in the month as higher price truckload shipments accounted for a larger portion of total shipments. Less than truckload volumes were a smaller percentage of the freight mix. The expenditures index was also 25% higher year over year and 95.5% higher than June of 2020. The report estimates that roughly 10 percentage points of the year over year change was tied to higher diesel fuel prices. LTL rates were up sequentially in June by an undisclosed amount. Denoyer said normal seasonality will likely keep the index in positive territory throughout the end of the year, with December logging only a 2% year-over-year increase. The data was set up 32% in the first half of 2020 compared to the same period in 2021. The TL Long Haul Index, which excludes fuel and accessorial surcharges, fell 1.8% from May. However, the index was 11.6% higher than June of last year and 27.8% higher than June of 2020. Quote, after an extraordinary truckload rate cycle, the market balance has shifted, with capacity now growing briskly and demand falling, which will limit further upside in the CAS Truckload Line Haul Index and likely press it lower in the coming months. End quote, Denoyer said. The year-on-year increase in the line haul index during June was the lowest this year, but in line with the average increases reported throughout 2021. Even as the market has loosened and spot rates have dropped in recent months, many large carriers have indicated that contractual rate increases continue to come in above inflation and the industry's higher cost profile. A better indication of contractual negotiations will come later this month when the public fleets report second quarter results. And Morgan Stanley sees tumultuous times ahead. Results from Morgan Stanley Sentiment Survey released Wednesday show that expectations around TL supply and demand and rates continue to signal weakening freight market. Quote, while the extent of the decline signals something more than just, quote, normal destocking-driven transportation slowdown, but less than the broad recession of 2008 and 2009, as one broker put it. We expect tumultuous times ahead. Either way, and look to next quarter for more definitive signs of its ultimate magnitude. Analyst Ravi Shankar commented in the report. A recent shipper survey conducted by the firm registered the fourth lowest economic outlook from respondents in the 20-year history of the data. Data used in the CAS indexes is derived from freight bills paid by CAS, a provider of payment management solutions. CAS processed $37 billion in freight payables annually and on behalf of its customers. So again, it looks like, the economy is slowing down again, which is not surprising, but certainly not great news. But again, we have to go through this to get out to the other side. All right, one last article here, just a little bit of a history lesson. Powell is repeating Burns's mistake. The recent loss of control of inflation and worry about potential stagflation ahead is to a very large extent repeating the history of the 1970s, a period that is worth serious study to learn the lesson. The appointment of Arthur Frank Burns as a new Fed chair to replace William McChesney Martin, a hawker to fight inflation, was revenge. It was Martin who maintained a tight policy in the early 1960s that made Richard Nixon fail in his first presidential election. As Nixon finally got the seat, he made it a high tone that the Fed would be cooperative. Yeah, we see how that worked out when the Fed was cooperative with the administration. By the mid-1950s, Burns was already the chairman of the Council of Economic Advisors. He was a famous professor in the business cycle field. His doctoral advisor was the founder of the cycles study, Wesley Chair Mitchell. Their joint publication of, quote, production trends in the United States since 1870, end quote, in 1934, and measuring business cycles in 1946 laid down the foundation of how the National Bureau of Economic Research date cycles. When the later Fed chair Paul Adolph Volcker Jr. was doing his undergraduate study, Burns was his influential teacher. Burns was highly praised and trusted by Dwight Eisenhower. This made him a natural choice as a Fed chair for Nixon, while a professor with a strong academic background would likely be a good economic advisor. He might not be appropriate for Fed chair, especially in countering political pressure to ease by the president. Before Burns became Fed chair, he had been quite thorough about the economy by providing good advice to the president. However, academics are commonly yes men. He could not resist acting as a dove, at least in the beginning. Fair to say, the loss of control of inflation in 1972 was not due completely to Burns' easing. The huge financial deficits due to the Vietnam War and unpegging from gold afterward were more relevant. While inflation was already rising in the late 1960s, Martin did tighten accordingly, but as Burns assumed office, he cut the rate to below inflation as the accompanying chart shows. At a time, unemployment rate edged above from 4% to 6%, which was widely regarded to be a natural reaction. Soon after, GDP growth surged, unemployment declined, and of course, inflation skyrocketed. When he was aware by early 1973 that he had to fight inflation, it was already too late. Monetary policy takes at least a year to become effective. When the hike was done aggressively from then on until mid-1974, a deep recession was inevitable and unemployment shot up to 9%. Back in the 2010s, there was a famous professor of the Great Depression, Ben Shalom Bernanke, who also moved from chair of the Council of Economic Advisors to Fed chair. He made prolonged easing until 2015, 7 years after 2008. Incidentally, the current Fed chair, Jerome Hayden Powell, reacted reacted to inflation only very recently. Historians conclude Burns's ideology as fluctuating between hawk and dove. When Powell became Fed chair, he was frequently threatened by Donald Trump for tightening too much. 3 years on, Powell was again unresponsive to inflation, then tightening aggressively, leading to a recession ahead. Again, we're kind of reliving the same thing all over again. Unfortunately, I was a small tot in the 1970s. I don't remember much about that other than just watching sports on TV and going to Cougar games on Saturdays. So anyways, all right, well, that's everything I had for today. Again, it's kind of a grim picture out there. Don't let it get you down. Go for a walk, get some sun, get some exercise. Maybe not, you may not want to go for a walk right now. It's only, 3 o'clock here in the mountain time zone. So it's probably still a little warm wherever you're at, but go get some exercise, eat some healthy food, and take care of yourself, and everything else should just fall into a place. So, all right. Well, if anybody needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And hope everyone has a fantastic Thursday evening. Astros play again tonight. They threw up a stinker last night. But the good news is Shohei Ohtani cannot pitch every single game. So that is the good news. We'll probably get somebody we can pound on tonight. So they do play, I think, about an hour or so earlier. But check them out if you have them on your broadcast. All right. Well, I'll be back tomorrow with the weekly wrap up. And like I said, if anybody needs anything from me, you know where to find me. Have a great evening, guys. Bye-bye.